You know that feeling when the market drops 4% in a single afternoon, and you find yourself refreshing your brokerage app like it is a slot machine, half hoping the next poll shows different numbers. Yeah, that was a lot of us last month when the AI names finally caught a cold. Nvidia, Palantir, the whole gang, suddenly down 18, 22, 30% from their highs. And every financial talking head on TV started using the word bubble, like they'd been holding it in for 2 years. Here is the thing nobody wants to say out loud. The biggest mistakes investors are making right now during this AI correction aren't the ones the headlines keep screaming about. The real damage isn't coming from people who bought too much Nvidia. It is coming from people who think they're being responsible, careful, even smart. I want to walk you through it. Because if you're anywhere near retirement, this matters more than the noise. I'm Lily, and most of my week disappears into earnings reports and arguments with my own portfolio. Look, I'm not here to tell you whether AI is a bubble or a revolution. And honestly, it is probably a little of both. What I want to do is something more useful, which is show you the 5 quiet mistakes I'm watching real investors make in real time during this correction, and then you decide which ones apply to you. Think of your portfolio like a garden you've been tending for 30 years. A correction is a frost. Some plants die, some come back stronger in spring. But the worst damage almost always comes from the panicked gardener, not the weather. That is the picture I want you to hold on to, because every mistake we're about to talk through is really just a gardener doing something rash when they should have been pouring a cup of coffee and waiting. The first mistake is selling the whole garden because a few tomatoes took a hitch. Over the last few weeks, I've talked to people who watched their AI exposure drop 25%, panicked, and dumped their entire equity allocation. Not just the tech stuff, everything. Their dividend payers, their healthcare, their international funds, all of it now sitting in a money market earning roughly 4%. On paper, 4% feels safe. But if you are 58 years old, with maybe 25 or 30 years of life ahead of you, inflation eats that return alive. Vanguard has published research suggesting that investors who flee to cash during corrections capture, on average, about half the long-term return of investors who stay invested. Half. That isn't a rounding error. That is the difference between leaving your grandkids something meaningful and leaving them a thank you card. The second mistake is the opposite extreme, and it is just as common. People are doubling down on the exact stocks that just got punished because they read somewhere this is a buying opportunity. Look, sometimes it genuinely is, and sometimes Nvidia at a 30% discount really is a gift. But here is what I'm watching happen. Folks who already had 40% of their portfolio in 5 AI names are adding more because the price dropped. That isn't investing. That is a gardener who lost half his tomatoes deciding the solution is to plant only tomatoes. When one frost wipes out a quarter of your net worth, the answer isn't more of the same crop. It is asking why your garden was that concentrated in the first place. Now here is where it gets interesting, because this third mistake is the one almost nobody talks about. A lot of folks in their late 50s and early 60s set their 60-40th split back in 2019 or 2020, and haven't touched it since. The trouble is that after the AI run-up, that 60-40ths quietly became 78-20 seconds, without anyone noticing. When the correction finally hit, the cushion they thought they had wasn't actually there. The frost came, and the greenhouse roof had blown off 2 summers ago. This is why annual rebalancing matters so much more than picking the next hot stock. It is boring, it is unsexy, and it has probably saved more retirements than any single investment decision in history. Before we get to the last 2, and these are the big ones, I want to ask you something. If this is useful, If I am earning the 30 minutes of attention you might give this channel each week, hit subscribe. I'm not going to do the whole dance. YouTube just shows this stuff to more people like you when you do. And frankly, the algorithm has been brutal to slower, more careful financial content lately. If you want more of this and less of the screaming man in a Lambo content, you know what to do. Okay, the fourth mistake stings because it feels so responsible when you're doing it. People are tax loss harvesting their AI losers and then immediately buying a different AI ETF that holds basically the same companies. Technically not a wash sale, technically very clever, but what you've actually done is lock in a real loss on your tax return while keeping the exact same risk exposure. You haven't reduced anything. You've just paid a small amount in transaction costs to feel like you did something. Real tax loss harvesting in a correction means rotating into something genuinely different, like broad market exposure or value, or even just sitting in a total market index for the 31-day window. The IRS wash sale rule exists for a reason, and trying to outsmart it usually means outsmarting yourself. The fifth one breaks my heart because it tends to hit the people who can least afford it, letting the correction scare you out of contributing this month. Over the last 6 weeks, I've heard from people who paused their 401k contributions because they want to see where the bottom is. Look, I get it. It feels insane to keep buying when everything is red, but you are buying shares at a discount. That is literally what dollar cost averaging was designed for. If you are 55 and you skip 3 months of contributions during a correction, you're not protecting yourself. You're handing you a smaller retirement. The frost is exactly when seeds are cheapest. And skipping the planting season because the weather looks ugly is how gardens die slowly, not dramatically. So what does a sane response to an AI correction actually look like? Here is what I keep coming back to. First, you check your actual allocation, not the one you set up 4 years ago. And if you meant to be 60/40ths and you are sitting at 78/22, you rebalance methodically over a few weeks instead of in one panicked afternoon. Second, you look at concentration. If any single stock is more than roughly 10% of your portfolio, even one you love, even one that has been good to you, you trim. Not because it is wrong, but because grown-up gardeners don't bet the whole plot on one crop. Third, you keep contributing, boring, automatic, every paycheck, no matter what the headlines are doing. And fourth, and this is the one I want you to really sit with, you ask yourself whether the AI exposure you have is something you chose, or something that just sort of happened because the S&P 500 is now roughly 30% concentrated in 7 companies. That last point matters more than people realize. A lot of folks who think they own a diversified index fund are actually running a tech-heavy portfolio by accident. When Apple, Microsoft, Nvidia, Amazon, Meta, Google, and Tesla make up most of your diversified fund, a correction in AI isn't a sector problem. It is your whole portfolio's problem. That is not a reason to panic. It is a reason to look honestly at what you actually own versus what you think you own. Look, I don't know if this AI pullback is the start of something deeper or just a healthy breather before the next leg up. Nobody knows. And anyone telling you otherwise on the internet is selling something. What I do know is that the gardeners who survive frosts aren't the ones with the best weather forecasts. They're the ones who built a garden that could handle a bad season without burning the whole plot down. Here is what I want you to leave with, and I genuinely want your answer in the comments. Of the 5 mistakes we just walked through, the one that hits closest to home isn't your neighbor's mistake. It is the one you're quietly making right now, or were about to. Tell me which one. I read them. And if you got value from this, subscribe, so the next correction doesn't catch you flat-footed. I'll see you next week.